back. The shipping industry is taking a hit from the coronavirus outbreak. Container ships are leaving Chinese ports as little as 10% full as operators brace for financial losses. Joining us now is John Kartsonas. He's founder and managing partner at Breakwave Advisors. And John, thanks so much for joining me today. When we try to just determine how big of an impact the coronavirus is having on the shipping industry, how do you see that?
Well, when it comes to shipping, China is the most important area in the world. If you look at the incremental demand, 80% of that comes from China. Whether that's crude oil or iron ore, which they're still making material, China is very important for shipping. So what has happened now is that suddenly the whole Chinese economy has come to a standstill. Whether that's manufacturing, infrastructure spending, the supply chain, everything is in a standstill. So when it comes to shipping goods in and out of China, things have come basically to a halt. That's very important, obviously, because the shipping industry has been hit the hardest of any other asset class today. If you look at the Baltic Dry Index, which is the most important index in shipping, is down some 80% in the last few months. No other asset that I know of is down that much.
Well, you have 20 years experience in the shipping industry. From your perspective, what is the best way for shippers to deal with this type of disruption? How do they do that?
Well, it's very difficult, obviously, because if you don't have a cargo to move, nobody's going to pay you to move anything. You just sit there and wait. So if that's kind of transitory, that's a good thing. Eventually, things will come back, and then you're going to have demand again for transportation. But there isn't much you can do. I mean, again, if you look at the whole world, China is where everything is shipped to and shipped from. The rest of the world, there isn't enough demand to make for the shortfall. If this again happens to improve in the next few months, you're going to see a sharp recovery, obviously, in shipping rates. Again, the Baltic Dry Index, which measures rates, you're going to see them maybe moving much higher from here, and obviously shippers are going to start making money again.
And John, it's also important to point out that it's not only shippers that are leaving China, but also just in terms of trying to ship goods into China. There's also some disruption there, just in terms of China being able to have anyone there, employees. There's lack of workers there, just in terms of distribution channels, right?
Exactly. So if you look what's happening, for example, ports are operating at like half the utilization. There are no workers there. Then you have to ship the goods to a port, and from a port you have to ship it mainland, but there is no transportation. The rails are not working. So it's the whole logistical chain that has come to a standstill, and obviously that starts from the ship.
Mm-hmm. John, how long do you expect this to weigh on the shippers? Are we talking a few weeks? Are we talking months, a couple quarters? How do you see that?
So that's a very good question, and that doesn't affect only shipping, but affects everything in the investment world. The difference here is that if you see shipping, it prices an environment that's going to stay like that for a while, where the rest of the world is pricing some kind of an improvement. And I think that's where probably the opportunity is between two different worlds. Shipping is telling you things are going to stay weak for a while, and the rest of the world is telling you things are getting better.
John, you helped launch an ETF. Its ticker symbol is BDRY. It tracks freight futures. When we see this type of disruption because of the coronavirus, have you seen a spike in volatility because of this disruption, or a spike in demand, I should say, for your ETF?
Yeah, so basically, BDRY tracks freight through futures, and year-to-date is down 40% plus. And of course, that's because rates are down, freight rates are down. But we have seen significant interest because obviously that's the recovery trade. If it happens, you expect that to improve, and I think investors see that as an opportunity. Again, it has to do with the difference between what everything else is pricing versus BDRY. BDRY is pricing a very bad environment. The rest of the world is pricing some kind of an improvement.
John Kartsonas, thanks so much for joining me today.
Thank you very much.